What's going on, everybody? This is Rodcaptrade. Really quickly, I just want to go over three important things I think that you could implement into your trading that will really help your trading elevate to the next level. Okay. Now, out of these three, there's actually seven key steps that I think will take you to the next level. For free game, though, we're gonna talk about three of those. The first one of the three is going to be the squeeze. All right. Really quickly, guys, I tend to use TD Ameritrade Thinkorswim platform. And they have what is called the TTM squeeze. And basically what the squeeze is the squeeze is an indicator created by Dr. John Potter. Now this works, I mean, you could literally be an amateur and that's not going to stop you from being able to identify a squeeze. It's simply seeing if the indicator is red, the dots are red. Depending on the platform that you're using, either way, that's telling you that we are squeezing, we're consolidating, and you want to really pay attention to that. And so the squeeze is very important, guys, because before we get to a very critical level of a breakout or a breakdown, you'll have a period of consolidation first. So if you can anticipate or you can see where that consolidation period is at, then it'll help you be able to take those breakdown trades much better, okay? For a really quick example, let's just say that this is price, and we're moving up, and we come to a point, and then we come back down, and then we come to a point, and then we make our way back up to the same point, right? And basically you hear the word chop, you hear the term chop. That's nothing more than consolidation, okay? Another reason why this is so important, guys, imagine me pulling a rubber band, right? Really, really, really tightly, right? What's gonna happen to that rubber band eventually as I'm pulling? It's gonna pop, right? Same thing happens to tickers. As that ticker is squeezing, is consolidating, it is, that energy is getting tighter and tighter and tighter, and it's ready to release. Now, if we know that, guys, we can make a lot of money off of that, right? Another key important thing about the squeeze is going to be these histogram bars here. Now, these bars are going to be in various colors, 4 colors to be precise. They're going to be colored red, yellow. They're also going to be colored light blue. They're also going to be colored dark blue. Now, these histograms are actually going to let us know ahead of time which direction we're actually going to break up or break down at, right? So how great is that, right? Not only are we able to see when a big trade is going to happen, but by following these histogram bars and the direction, their slope, their divergence, we're able to anticipate where that breakout or breakdown is going to be, right? And I'm going to show you how, right? So again, remember I said that these histogram bars are going to be colored various colors. Now the red is signaling that we are in bearish territory, bearish momentum. All right. And the yellow is going to tell us that we are basically a relief of the bearish momentum. So, you know, we get a sell off or anything like that, that would be red. That would be signaling a red bearish momentum. Sellers are in, they're in control. Yellow would be a pause from that bearish momentum. So maybe buyers came in, slowed things down, and now there is possible opportunity for bulls to come in and pull that thing back up, right? So yellow is going to be a relief from that bearish momentum. Light blue is actually going to be, yes guys, it's going to be bullish momentum. So bulls are in control. All right. And a dark blue, guys. Dark blue is going to be a pause of bullish control. Doesn't necessarily mean that bears are in control. It just means that, hey, maybe we're consolidating again. Remember that word, guys. Let that word stick with you, okay? It's going to stick with you for your duration of trading, all right? So we have red, which is bearish. We have yellow, which is a relief from bearish momentum. We also have the light blue, which is for the bulls. That means that bulls are in control, as well as dark blue. Dark blue is a pause of bullish momentum. All right, guys. So I'm going to show you guys how to read this. So we see the squeeze. We know that something big is possibly about to happen. Now we just want to anticipate which way we're going to break out at. All right. So again, guys, remember the slope, the direction that these bars are going. You guys can see that we're going in an upward direction here. Upward direction, guys, remember that's going to be a bullish direction. That's bullish momentum, bullish divergence. Okay, don't forget that. So bulls. All right, and if it's going down like this from top to down, guys, see how this is the peak of the bars here. See look, each peak, and they're actually starting to go down, right? They're starting to peak down, right? So those peaks are making lower lows. It's very bearish, right? So if you draw an arrow going down, it'll be bearish momentum. So depending on where we are at on this chart corresponding to these bars, for instance, if your candlesticks were here, we were here looking at a daily time frame. So say that this was the chart. These are candlesticks. I'm going to correspond the candlesticks to the actual bar, and each bar represents will have a candlestick aligned with it. So it'll let you know, just like how you read from left to right. If you're reading these candlesticks, you're reading these histogram bars from left to right along with the candlesticks. So it'll really help you to anticipate the direction. So again, from here, we're ascending. So if you're on this side of the chart, then you can already see that we're actually picking up and we're making a bullish divergence on the graph. Okay, so this is a bullish direction, right? We're going up. So if the candlesticks are on this side of the chart, guys, then we have bullish momentum, right? So you can anticipate that we're possibly going to continue to make higher highs depending on where we're at on this histogram bar. So here you can kind of see that we're descending. This would be, again, bearish divergence, bearish momentum. And so at that point, guys, if your candlesticks were, let's say, were still bullish, you would really want to watch that because they're not in agreement with each other, okay? If price action is increasing, then your histograms, the direction of the histogram should also be increasing as well. It's that simple, guys. I can't make this stuff up. Now, if the candlesticks are increasing and your histogram bars are decreasing, then those are giving you two very conflicting signals, okay? And at that point, you may want to just sit in your hands and just stay cash. Cash is a position, and just wait it out and see what happens from that point, okay? So again, on the decline down, guys, it's very important. On the decline down, these bars are usually red depending on the platform that you're using. And on that increase up, that very first increase up, these are typically yellow, guys. So knowing that, if I see yellow histogram bars, then you can kind of start to anticipate that we might be about to make an increase, ride up, especially if we are at an AOD, guys, an area of demand, okay? Area of demand is nothing more than support level off of a weekly, daily, any kind of critical level. It can even be a 4-hour level, guys. All right, so let's say that we found a area of support, and I see that these histogram bars are starting to switch over to yellow. I may want to start to look to get in called at that point, right? Which means that the price is increasing, okay? So you really want to watch that now. Now, once we're actually above the squeeze, leveled out line here, we call this 0. Once we're above the squeeze, the bars will instantly turn light blue. All right, guys, and that is telling us that we are in full-on bullish momentum. And by that point, usually the price will continue to increase. And from there, it's to the moon. And from that point, usually once you start to make these lower lows, you start to see that decline in price or in the histogram bars. These will typically be, you guessed it, guys, dark blue. All right. So once we start making that decline there, those histogram bars will turn dark blue. That is signaling that, hey, if you are in calls, you might want to take profit. I've never seen a man go broke taking profit, guys, so that is definitely something that you might want to consider doing, all right? The Bollinger Bands is actually a study that you can also find in TD Ameritrade. You can find it on TradingView, any other platform usually. I use the Bollinger Bands every single day in my trading. It actually helps me out a lot. So Bollinger Bands are going to be, it's going to be an indicator of basically almost moving averages, you could say. It's going to be 3 of them. And they kind of form, a band almost, right? The thing about the Bollinger Bands that I want you guys to really remember is that you can use them as resistance and support. Now, really quickly, for my newer traders, I just want to go over resistance and support really quickly, okay? Visualize with me. Imagine that I had a basketball and I threw that basketball up. What's it going to hit? It's going to hit the ceiling, right? The ceiling is going to be your resistance. So imagine that ball being price action, being candlesticks. So as the candlesticks are approaching that resistance, approaching that ceiling, one or two things is going to happen. If I threw that basketball hard enough, it's going to break through that ceiling. Probably keep going until it hits the next ceiling. Or it could hit that ceiling and come back down. Now at that point, if it does come back down, guys, what's it going to hit? Well, we know by, of course, gravity that it's going to hit the floor, of course. But the floor, inevitably the floor is going to be your support, guys. So again, the ball is going to be your price action, and you can throw that ball up and down all day. But the only thing that's going to do is going to bounce off of the ceiling and it's going to bounce off of the floor, right? It's all that price action is. It's all that it really is at the end of the day. When anything falls, it falls into demand. When it rises into supply, okay? So just remember that, guys. So these 3 bands here, we want to call these this is going to be the top band, it's going to be the middle band, and also this is going to be the bottom band. Now, for short, I call the Bollinger Bands BDs. Remember that first analogy that I gave you guys about the rubber band, right? The more I stretch that rubber band, it's going to get tighter and tighter and tighter. Okay, so eventually what's going to happen is it's going to pop. Same thing with the Bollinger Bands, guys. The more and more that price action continues to consolidate, remember that word, guys, consolidate, chop around, trade side to side, the more and more it consolidates, the tighter and tighter and tighter that range gets, the tighter and tighter these Bollinger Bands are going to get, guys. And see, we want them to be really, really tight because at that point, we know that price is ready to release in either direction. Now, that's really important because typically once you break out of either of these bands, once you break above or you break below, typically you will head to the next level. You will head to the next band. If there is no band above or beneath that current band, then you'll have to use levels. But for now, guys, I want you guys to remember that these bands can also be used as support and resistance levels, guys. All right, so for instance, if I have a candlestick here at the bottom of the bottom band, which is also great support, guys. If I see that we're making our way up, increasing, usually with volume or anything of the nature, I can assume that I'm going to tag the middle band. Now, if I know that and I take a risk, then there's a chance that I can make some money there. Same thing goes if we end up at the middle band and we're consolidating at the middle band, which means that we're chopping, right? And we start to increase and make our way up. Usually we will target the top band. Now, you know this and you see that price is in fact increasing, divergence on the squeeze is increasing, going upward in a bullish fashion. You can put 2 and 2 together, guys, and you can assume that we're going to tag that top band. Now, at that point, guys, if you take a risk, you probably make some money off of that. Remember, guys, that top band is a key level of resistance, right? So if we tag that resistance level, guys, and we fail to break, then you can assume that we're going to probably more than likely tag that middle band. And from there, guys, vice versa. Either we're going to consolidate on that level and bounce off and head back to tag that top band, or we're going to more than likely consolidate and drop down to that middle band. And that is essentially, again, trading in range. Nothing more than this. Right? No, my lines are looking totally crazy. Also, imagine this. Imagine that we are, in fact, let's think about a daily time frame. So each one of these candlesticks is going to be a day's worth of price action, guys. Let me give you guys some more free game real quick. Imagine that each one of these candles is a daily candle, guys. So each time that we make a move, it is a day's worth of price action. Now imagine that we are sitting at this middle band here. We have been consolidating for days at a time. We begin to increase and head higher. Now, if the squeeze on the daily time frame, we're looking at the daily time frame, we're looking at the squeeze histogram bars, and we're seeing bullish divergence on the squeeze, I would be inclined that we would push higher. Now, if I know that, I would also be probably inclined to swing some calls, which means that I'm anticipating that the price is going to increase. So again, this could be an edge for you for your strategy, and allow you to make some profit. All right, guys. Stacked EMAs stands for stacked exponential moving averages. Okay. In a nutshell, guys, moving averages is nothing more than another indicator that's going to keep track of the average of how a stock is moving. Okay, so let's just say that a stock is, moving upward, and over time, stocks will decrease, increase, but in the increase and the decrease, guys, these stocks are, there's a range that they're trading in. There's a common denominator, a common factor that they tend to revert back to. And so these different moving averages, depending on what day, what time frame you're looking at, this is going to be a different moving average, right? So the critical thing about this is that stacked EMAs is going to be a combination of different days of exponential moving averages. It's going to be a combination of about 7 to 8. Can't really tell you guys the exact format of it, but I'll tell you what, in the paid version, I actually give you my stacked EMA script. How's that? All right. So really quickly, stacked EMAs actually allows us to stay on the right side of the market. Okay, reason being, if we are in a confirmed uptrend, guys, let's say that we are in a confirmed uptrend, meaning that the market is in fact going in an upward direction over the bigger time frame, then we can assume that we will continue to rise. Okay, so even if we were to let's say that this is the trend, we're in an upward trend, a bullish trend, right? We're in a bullish trend and price is increasing. Even if we were to, let's say, pull back a little bit, because the overall trend is bullish, we should pick up right where we left off and head higher. That's usually how that goes. Same thing for a bearish trend. If you're in an overall bearish trend, guys, and you rise, you should fall back into that trend, which was a downward trend. Okay, so knowing which trend that we're in ahead of time allows you to be on the right side of the market, guys. For instance, anytime that we are in a bullish trend, depending on the time frame I'm looking at, the stack DMAs is actually going to light up green on my charts. I'm serious. The algorithm actually lights up green for me. That's indicating, telling me, hey Rod, whatever time frame you're looking at, the stack DMAs is green, it's a go. We're in an uptrend. The bullish momentum is there. All right. Now, if the stack DMAs were a light red, then I know that we're in a downtrend. And so if I'm looking to get in calls, which means that price is in fact going to increase, or at least I'm anticipating that it's going to increase, I may want to wait for the stack DMAs to turn green, right? It's the smartest thing to do, okay? The trend is your friend. Never forget that, guys. The trend is your friend. Don't trade against the trend. All right, so again, these stack DMAs, this algorithm allows me to be on the right side of the market. I cannot tell you guys how important it is to trade with the trend, guys. Looking at a weekly, a daily time frame, the stack DMAs work best. For my newer traders, you always want to check SPY and the Qs, QQQ. It's going to be the overall market, SPY is, and the Qs is actually going to be your tech sector, okay? Always check SPY, always check Qs before you decide to trade any single day, all right? It took me about a year before I figured that one out. I'm going to save you guys some time, okay? So always check SPY and QQQ before you decide to trade. If SPY and the Qs aren't looking, like they want to make a good move, a huge move, or they look like the price action just isn't there, it's a lot of consolidation, you may want to chill, sit in your hands, cast as a position, guys. Remember that, all right? So again, me personally, I look at the stack DMAs to check SPY and check Qs. If SPY and Qs are both bullish, and on the daily and the weekly time frame, the stack DMAs are green, I'd be inclined for some calls that day if price action was, looking decent. Or I'll wait it out, and if SPY or the Qs or the ticket that I'm looking to trade is breaking out of a range, then I might look to trade that ticket for the day, okay? Again, guys, this is the stack DMAs, and it also helps me to anticipate and to keep track of the market direction. It's nothing more than a compass. It's allowing me to see which direction the market is in and could possibly continue to be in, all right? Using that algorithm, guys, it really, really, really could give you an edge with your trading. Thank you very much.